Bjarne Schieldrop joins the show. He is a chief commodities analyst at SEB Research. We're talking about his outlook on oil. Welcome to the show, Bjarne. Good to see you. Pleasure to host you today.
Thank you for being here.
In your recent research report that you published in the first week of October, you wrote, so if worst came to worst, and if the Strait of Hormuz was closed for a month or more, then Brent crude would likely spike to $350 a barrel. The world economy would crater, and the oil price would fall back to below $200 a barrel again over some time. But the risk for this currently seems very remote, and both the US and China would likely move in to try to reopen the strait if it was closed. Walk us through that scenario and some of the assumptions behind a $350 oil target under that scenario.
Yeah, I mean, if you look back in history, and you don't need to look long back, far back, you can see that when you have commodities, severe disruption in supply of specific commodities, they tend to move like 5x or 10x the normal price. I mean, look at nickel price when Russia invaded Ukraine. It went from $20,000 to $200,000 per ton, and of course it was due to some technical reasons as well. But then the nat gas price in Europe moved to like $550 per barrel of oil equivalents in Europe, and to $385 per barrel of oil equivalents in Asia on the LNG market, and then fell back, of course. And when you calculated these costs to the share of the economy, the pricing of electricity on the basis of that nat gas was like 20% of GDP for a whole year, priced on the 2023 contract, which is just unachievable, which the economy would crater, and obviously the price fell back rapidly. And if you look at the oil flowing out of the Strait of Hormuz, we're talking 18 to 20 million barrels per day flowing out there, and that accounts for close to 20% of global demand. So for sure, if it was really closed and you lost 20% of supply, the price would just explode. And the fact that we have only witnessed prices moving up to $149, $150 historically, which is a much higher price in today's money. It doesn't mean it can't move there if we get this real supply, and we really have to move back to the 70s to see this 5x move in oil prices. But it's so far long back for oil to have seen these massive spikes of 5x normal price or 5x the prior year price. So we kind of have forgotten, and markets tend to be surprised when things happen which hasn't happened for a long time. I mean, look at inflation. Suddenly spiked. We haven't seen since the 70s and 80s, and then pandemics. We haven't had a pandemics in 100 years, and governments panic around the world and stimulate the global economy with 10x the stimulus of global financial crisis. So just the fact that just long ago doesn't mean it can't happen again.
Well, we know that the Strait of Hormuz is very important and vital for transporting oil from the Middle East to the rest of the world, but do they not have other alternatives besides the Strait of Hormuz? Pipelines, perhaps, inland?
You do have one pipeline going from east to west from the Strait of Hormuz and into the Red Sea, and it holds something like 5 million barrels per day of capacity. Saudi Arabia is holding that pipeline. So, as an alternative outlet, Saudi Arabia could ship oil into the Red Sea and out into the global market, either up into the Mediterranean or down through to the Persian Gulf area, or around there, and around Yemen and to Asia. But of course, then you have the Houthis who could threaten that oil. So for sure, there would be a lot of adaptation to such a supply shock, losing 18 million. And some would be adapted by oil coming out of strategic oil reserves in the US and the OECD countries. China would use from strategic reserves, and Saudi Arabia would channel oil through the Red Sea rather than to the Persian Gulf. So yes, we always have a market adapting quickly and as fast as they can. And then, of course, you would have Russia lifting production by 1 million barrels, stuff like that. But I mean, we are talking like 20 million barrels, and even with shifting oil to the Red Sea by 5 million barrels, we're still short like 15 million barrels on the supply side.
Now, if the Strait of Hormuz was closed by Iran, presumably through a naval blockade of some sort, right? What does this imply? That there has been a significant escalation in this war between Israel and Iran. Perhaps Israel has already retaliated by this point. What needs to happen for the Strait of Hormuz to be closed?
I think we recently had like 200 ballistic rockets hitting Israel from Iran. Many were intercepted though, like Tuesday 1.5 weeks ago. For sure, Israel is going to retaliate. That is for sure. We don't know when, we don't know how. We know that they have like a mile-long list of possible targets, which they could choose from. Is going to be just a soft reply like we saw in April, where like it's just two dogs barking at each other and then sort of moving back? Or is it going to be a hard hit to military installations? Or is it going to actually hit the oil installations of Iran, hurting and closing down Iran's possibility to export currently around 2 million barrels per day of oil, including condensates? And if Iran then is losing its ability to export oil, I mean, it could hit back by closing the Strait of Hormuz, just saying, okay, if we are not going to be able to enjoy oil exports, enjoy oil income, then why should the rest of OPEC enjoy that? And we want to hit back at the world, hit back at the US with high oil prices. It could be a possibility retaliation by Iran to put sea mines in the Strait of Hormuz, for example. But I think so. That is one possible route to closure of the Strait of Hormuz. The other is that it's just war in itself is unpredictable. And then suddenly it spirals out, and one action takes the next to the next level. So it's like a tit for tat escalatory ladder where Israel has to respond hard, Iran even harder, and then suddenly you have it going. The US is dragged into the equation, etc., etc. This is the unpredictable of war, is just keeping the door open for anything when you start to shoot directly between Iran and Israel.
Before we continue with the interview, I want to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrustCapital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on iTrust.capital/David in the link down below, or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. You also wrote that if the Strait of Hormuz were to close, China and the US would likely move in to try to reopen it, is what you wrote. How would they do that?
I mean, you would see warships going full speed to the Persian Gulf and try to open it with force, shoot down military installations in Iran to be able to demine the strait. If that happened, they would open it with force because they would know that, this kind of energy shock, it's like the 70s.
So basically a full-scale escalation against Iran. Well,
yeah,
that in itself, wouldn't that in itself be bullish for oil as well, even without the Strait of Hormuz closing, that scenario you just described?
Yeah, exactly. So if you take sort of the first step, assuming that Israel actually take out the Karg Island export capability of 1.5 million barrels and start to hurt Iranian oil installations, the world can easily cope with that because OPEC Plus has some 5 to 6 million barrels per day of reserve capacity. So just losing that isn't all that problematic for the oil market. And that is why oil prices are fairly muted in action, still under $80, sniffing at the high 70s or sniffing at the $80, but still a little bit below. But then, when that happens, you're actually starting to get closer to the really bad scenario. So then the risk premium would add much more to the oil price than it does now.
I would like to understand how oil reacts to war in the first place. So take a look at this chart of the long-term price of oil. Following September 11th, 2001, the Americans, as you know, went into the Middle East, and that war lasted for the latter half of the last 2 decades. How much of this uptrend in oil between 2001 to basically 2008, before the great financial crisis, and then we had a big correction there, how much of that was due to war? Or were there other more important macro factors involved, Bjorn?
I think it's always several factors on top of each other, because if you look at sort of the oil prices through the 90s, they were really low, right? So
Yes.
basically, capex spending through those years in upstream oil and gas was really low as well. And then you had war, like you say, in the Middle East with Iraq. But also you had this massive acceleration in demand from China. So low capex, low production growth capabilities, strong growth in China, and some curbs on the supply side due to war in the Middle East. So I think most of that upturn was quite sort of orderly. It wasn't like a war jump. It was a fairly orderly increase in the oil price due to these strong forces of subdued capex spending the decade before, and very strong oil demand growth from China and emerging markets.
Interesting. So let's talk about the other scenario. So instead of the Strait of Hormuz being closed, Israel has said that a possible retaliatory strike would be against the oil refineries of Iran. Iran said that if that were to happen, it would strike the oil refineries of other Arab countries friendly to the West. So that may include the UAE, for example. Under that scenario, what would the price of oil do?
I mean, it's a very interesting question, because if you look at the crisis we had with Russia, Ukraine, Europe, I mean, oil was flowing more or less like normal from Russia into the global marketplace. But the problem was that Europe used to import large quantities of oil products and feedstocks to produce oil products, both intermediary feedstocks and special crudes. So suddenly we had to reorganize the whole flow of oil products in the world. And we had this massive increase in diesel prices on top of the crude prices. And basically what you saw was that the normalization in refinery margins didn't really happen before a few months ago. And that is also when the oil price weakened. So a very stressed out refining margin means that the rest of the world refining system will run as hard as they can and buy as much crude as they can to produce the refined oil products, which is no longer produced by Iran, possibly. So it could upset the global oil market through very high refined product prices, possibly, and lift the oil price as a result.
If okay, so if oil refineries in the Middle East were destroyed, and I guess even if the Strait of Hormuz were closed temporarily, and we have limited supply of oil from the Middle East, how quickly could the rest of the world fill in that gap in production and refinery?
I think if you take the simplest one first, in terms of like losing 1.5 to 2 million barrels per day of crude from Iran into the global marketplace, that could be replaced very quickly by the OPEC countries, including, in addition, of course, Russia, which also could lift it. So I think that would be very quick, and it would actually be a very good thing for OPEC Plus, because they want to lift production by 2.2 million barrels per day gradually from December this year to November next year. And if the market loses like a couple of million barrels from Iran, that would be sort of full open door for them to actually put that back into the market. It would remove a lot of the downside risk for oil prices, and put it on a more steady footing around 75 to $85, rather than to drive the price to the sky. But market would be extremely nervous in that situation. You would start to erode and use up parts of your spare capacity within OPEC, driving it down to maybe like 3 million barrels of readily available spare capacity. And also, the scare factor of this escalating further would come on top of the steady oil price of around $80.
Let me show you my screen one more time, Bjorn. So this is the price of oil on October 1st was when Iran launched 200 ballistic missiles against Israel. And on that day, the oil price spiked and it remained relatively high. But before then, the oil price was trading around $69. If I'm reading this right, the market is only pricing in a $6 geopolitical risk premium?
Yes, and I think part of that reason is just the fact that you have this spare capacity in OPEC, which is more than enough to cover losses of Iranian supply, if that was to happen. Of course, it doesn't really, and then it probably assigns a minuscule probability that it really completely
Yes.
spirals out of hand involving the Strait of Hormuz.
If you remove the conflict in the Middle East right now between Lebanon, between Israel and Iran, would you expect the oil price to be much lower than it is today?
I mean, you probably will be like down to the 70 line, and I think the whole
Mm.
discussion then would be about two things. Will OPEC Plus lift production by 2.2 million barrels over the coming 12 months from December? And how will Chinese oil demand and the global economy develop? Those would be the two main topics because shale oil is fairly muted in its growth right now. So we're not going to drown in shale oil, but we're going to have plenty of new supply from Canada and Brazil and Guyana, including some more also from the US. So it's plenty of supply. And I think that is an interesting discussion. What will OPEC do? And I've been thinking a lot on that.
Yes, and looking ahead as well, how important is the Chinese stimulus package that was recently announced late September for not just the Chinese economy, but for oil demand?
I think it's taking away some of the downside risk in the market because I mean, the market has clearly been concerned about the development in the Chinese economy. Is it going to just unravel and fall yet lower? And now at least they will stabilize it at around 5% growth target and try to drive it up to that level rather than allow it to slip and tumble. So it takes away some of the outlier downside risks for oil. I think it doesn't necessarily drive Chinese oil demand right up. It's not like a humongous bazooka stimulus package.
Going looking forward, then we talked about OPEC plus being something you need to look at. What are some of the most important demand drivers for the next year? OPEC plus being a supply driver. What about on the demand side?
Of course, it's the total global economy per se. But I think it's interesting article and report from the International Monetary Fund, basically saying that from 2000 to 2005 to 2015 was great decade for emerging markets together with China. They were growing very rapidly and faster than the US economy. And then you had a very, very sad period from 2015 to now. But the coming 5 years, emerging markets, like 88% of emerging markets, are going to grow faster than the US. So it's a good setup for that part of the global economy, which consumes very little oil today. And of course, India is part of that equation. And if you look at Indian oil demand growth, it's now up to like 250,000 barrels per day, while China consume growth was closer to 500,000 barrels per day per year over the past decade. But when you look at sort of economic growth, per capita consumption growth in oil, we're quickly moving to like 350, 400,000 barrels per day growth per year in India. So India is now on par with China, and now it's going to take over and be a significant oil demand growth together with the rest of non-China emerging markets.
War aside, if you just take a look at the price of oil over the last couple of years, from 2020, its bottom during the pandemic when it went to negative for a very brief period of time, all the way to the top, we're looking at a 470% increase. Are the conditions still in place, Bjorn, for oil to retrace and stabilize around $100 a barrel?
No, no, I think it doesn't make sense for oil to stabilize around the $100, and it was some articles in the market where Saudi Arabia is giving up on the $100 target.
Mhm.
they didn't have $100 target. They could wish to have $100. It would be great for them to have $100 if it was possible to have that sustainably. But they've seen that if they try to push it too hard, you get too much shale oil, you get too much production growth from non-OPEC plus. So it's not a sustainable price to keep it at $100 for a long period. And so it trailed down, and the crisis from Ukraine-Russia event faded, along with refining margins coming back to normal.
So let's finish off in your projection that even if, let's say in the worst case scenario, revisiting your worst case scenario, we have the Strait of Hormuz close, oil goes up to $350 a barrel. Historically, when it spikes, it doesn't stay up for very long. Could this time be different? Could we expect oil to stay up to very high levels for a significant amount of time, or would that just be a temporary spike up to that level?
It can't stay up that long because it will just kill the global economy and it will kill oil demand. So oil demand will crash if it stays up there. So just due to sort of demand destruction, the oil price would fall back, even if you didn't have adapting factors on the supply side. But of course, you have adapting factors on the supply side as well. So no, it wouldn't stay up there very long. And then it would move, and if it stayed close, it would probably move down to like $200 and maybe somewhat below that. That would still be very painful on the demand side, but probably something like that.
And what is your, and again, you said that worst case scenario is very remote. What then is your base case scenario for how the oil price will evolve in the next year?
I mean, our base case, I think, is much like the market is pricing now. The base case is that we are not going to have disruptions in Iran. Israel isn't going to shoot apart oil infrastructure there. And oil demand is not going to be very strong, like 0.8 million barrels per day per year this year, and just 1.1 million barrels next year. So fairly muted oil demand growth. The global economy is not really firing on all cylinders. Rather, it's sort of a lot of weakness around, but still waiting for the acceleration, which is expected to come in gradually next year and then more the year after, which of course will be supportive for the oil. But most important is going to be, in addition to sort of acceptable demand growth of around 1 million barrels per day per year, what is OPEC going to do? OPEC Plus going to do? They talk about these plus 2.2 million barrels per day per year increase from December to November next year. Absolutely impossible without crashing the price. If they do that, price would crash hard. So they will most likely they will increase production by 180,000 barrels in December per day. But every month after that, they are still going to consider, shall we or shan't we increase, or shall we actually decrease? So they are going to be adaptable with this volume, but they are dangling it above the heads of shale oil producers, saying that, we are here, we are ready to put this back into the market. So if you just accelerate your production in the US, we have no choice just to drop this supply into the market. So you stay disciplined or we drop it. So I think OPEC is not going to do like it did in 2014, 15, 16, when they crashed the price by opening the taps. And the same again in spring of 2020, when they crashed the price to minus $37 VTI in the US and like $18 in Brent crude. They're not going to do that again. They want more volumes, but they also want the price, and it's going to be sort of a play between those two factors.
Is there a long-term equilibrium price for oil such that above that we would have demand crash, and below this range we would have a huge spike in demand? Do you know if that number exists right now?
I
That's
think it's
with the globe. Yeah.
It's a very good question, because yes, there is, but no one really knows what it is.
Yes.
And it's a constant hypothesis of what it is and where it is. Back in 2014, when the oil price was 110, the hypothesis was that the long-term balancing price was 90. And when shale oil was booming from 2016 onwards, the hypothesis was like that long-term price was 55. And now lately it has moved back to $70. So, that is the hypothesis of the market that, the balancing point where you have just enough supply and just enough demand is around $70. I think that is sort of the hypothesis of the market, but that hypothesis is changing all the time, depending on circumstances. And, when prices explode, it tends to drag up the long-term prices a little as well. So suddenly, it's blinking $80 on the long-term contracts because you have $110 in the front. But it's more like a drag effect on high prices spilling into the longer-term contracts.
Finally, Bjorn, is there a price theoretically at which it would be so high that the economy in the West or perhaps other countries around the world would be disrupted? We would have very high inflation. People would be unable to buy gas for their cars. At what price would that have to be?
No, I mean, if you have $200 per barrel and it stays there for a year, then it would have a very strong inflationary effect and very damaging effect on the global economy. Because it's such an input to everything we do all around the world at the same time. It goes into the production of coal even, so we use it for everything. So it tends to spread into all different activities around the world. No one can escape it. So more than $200 for a year, definitely very negative for the global economy.
Very good. Thank you very much for your updates today, Bjorn. Where can we learn more about you and read your research?
Oh, so I write on the open platform of SEB, SEB Macro Research. So if you go to SEB, the Swedish bank, and go to their research platform, you can sign up there for free, even if you're not the client, because it's open research.
Thank you very much, Bjorn. And we look forward to having you back on. And thank you for watching. Don't forget to like and subscribe.
Thank you for having me. Thank you very much.